Welcome. So this is a continuation of the previous video where we need to answer this case 2. This case was introduced in the last video, and this question, how much is the cost of the 9,700 units ending inventory, was also answered already using the FIFO periodic and FIFO perpetual methods in the past episode. Actually, this is already the fourth video of my merchandising series. And before you start with this video, it is highly recommended that you go back to these three right here. Their links are on the description below. So in this video, we are still going to answer the same question, which is how much is the cost of the ending inventory of 9,700 units, but we are going to use already other methods like the LIFO or the last in first out method, which is the exact opposite of the first in first out, and the weighted average and the moving average methods. So let's get right into it after this short video intro. Let's start with LIFO or the last in first out. As I have said earlier, last in first out is the complete opposite of FIFO because it assumes that the goods which were purchased last are the ones sold first. So this means that the ending inventories or the unsold inventories comes from the earlier batches or the first batches of goods acquired. So applying that in this case, so out of the 9,700 units, we are sure that the 1,000 units comes from here, the beginning inventory group, and the remaining 8,700 comes from this, the purchase on 331. So get the total of these two and we will have 45,390 as the ending inventory under LIFO periodic. Now, let's go to LIFO perpetual. But before we do that, I'll be direct. The merchandise inventory ending computed under the LIFO periodic is most of the times the same with the merchandise inventory computed under LIFO perpetual. I'll emphasize again, LIFO periodic and LIFO perpetual's merchandise inventory end amount is the same most of the time, but not all of the time. So when are they different? The answer is when the last inventory transaction of the company is a purchase transaction, just like in this case. So as you can see, the last transaction is a purchase in 12/15. So let's proceed to LIFO perpetual and let's start with the beginning inventory, which is 1,000 units times the 4.5 per unit. So we will have a balance and a running balance of 4,500. Now, let's go to 331 purchase, which is 10,000 units times 4.7. We have a total of 47,000 and the running balance is now 51,500. Remember, in this problem on 5.1, there is a purchase return of 2,300 units. So the problem is again the cost per unit. Again, the assumption is not changed. These returns came from the latest purchase, which is this one. So we have to put here the 4.7 and we have to get the total of 10,810. So since this is a purchase return, let's deduct this from the 51,500 and we will have a running balance of 40,690. Again, these 10,000 units, because of these returns, will be updated to 7,700 units. Now moving on, we have another purchase on 7.1, which is 6,500 units at 4.6. So you need to add the total to the running balance and we will get a running balance of 70,590. Now this transaction is followed by a sale of 10,000 units. So to fill this up, to fill the sales here, we have to remember the concept under the LIFO that the goods purchased last are the ones sold first. So here, out of the 10,000 sold goods, 6,500 comes from here at 4.6 and the other 3.5 comes from here, the purchases at 4.7. So again, the total of this sales, since this decreases the inventories, should be deducted from the running balance and the balance should now be 24,240. Next is on 11.1, we have a sales return of 1,500 units, which the cost per unit that will be applied for this one should be extracted from the most recent sales. So we have the most recent sales here at 4.7. So we have to put here the 4.7. So 15 times 4.7, then we will have 7,050. And if it is added to the running balance, we will have an updated balance of 31,290. And lastly, on 12.15, we have a purchases of 3,000 units at 4.8, which is equivalent to 14,400 all in all. Now, we need to add this on the running balance, and we have 45,690 for the 9,700 units remaining. Now, the solution for this LIFO perpetual is a little bit lengthy, right? So, if FIFO perpetuals, merchandise inventory, or the first in first out perpetual can be computed using the shortcut, which is always the FIFO periodic, you can also get the merchandise inventory under the LIFO perpetual using a shortcut, which is mostly the computation of the LIFO periodic. But as you can see here, they are not the same. Again, why is that? It is because the last inventory transaction in this case too is a purchase transaction. But can we still have a shortcut for this case? Of course. How? Again, we have 9,700 units remaining. But instead of assuming that it comes from the beginning inventories and the oldest inventories, let's assume first that the 3,000 of this 97 comes from the recent or the latest purchase right here. So we have 3,000 at 4.8, which is 14,400. And after that, of course, 1,000 units comes from here at 4.5. And the last 5,700 units comes from the purchase on 331, which is 4.7 per unit. So we have 26,790. So that's it. So if you total this, you're going to come up with a sum of 45,690, which is the same as this one. One last thing before we end this slide, I would like to emphasize that the LIFO measurement of ending inventories or the last in first out method is not allowed under IAS 2 or the standard for inventories. So if your country adheres to IAS and IFRS accounting standards, then you should remember that LIFO is not allowed. But why did I include it here? It's because maybe you will be asked to convert the merchandise inventories valued using LIFO into other methods like FIFO and weighted average methods. So you need to know the logic behind last in first out method. So that's it for this slide. We will have the average method next. Let's have the same case again, but let's get the merchandise inventory end using the average method. So we have average periodic and average perpetual also. So let's start with the weighted average periodic, in which you just have to get the cost per unit by getting the total goods available for sale in cost and divide it by the total goods available for sale in units. To make it clear, let's apply that to this case. First, let's get the total goods available for sale. How to get that? I've told you earlier that it is just beginning inventory plus net purchases. However, as you can remember, the net purchases is composed of gross purchases plus freight in, less purchase returns and allowances, and less purchase discounts. Now, let's apply that here. So let's start with the beginning inventory, which we have 1,000 units at 4.5, so we have a total of 4,500 plus gross purchases. But in this case, we have three groups of purchases. One group was purchased on 331 with 10,000 units at 4.7. However, remember that 2,300 from this have been returned. So meaning 23 times 4.7, that's 10,810, should be deducted in order to arrive at the total goods available for sale. We have another group of purchases, of course, on 7.1 and of course on 12.15. So we have the beginning inventory of 4.5 plus the gross purchases minus the purchase returns, and then we will get the total goods available for sale at cost worth 84,990. So in this case, as you observed, there are no purchase discounts and freight in. So let's assume that this cost per unit, the 4.5, 4.7, are already net of freight and net of discounts. So again, the total goods available for sale in cost is 84,990. Now, let's get the tigas in units, or the total goods available for sale in units. So if you add this beginning inventory in units plus the purchases in units, of course, less of purchase returns, then you will get 18,200 units. So meaning, if 84,990 is the total cost of 18,200 units, then the per unit cost in the average is 4.67. How did we get that? That's 84,990 divided by the 18,200 units. And if the remaining inventory is 9,700, you just have to multiply that with this average cost of 4.67, and then you are going to get 45,299 as the ending inventory under the weighted average method, or the average periodic. How about the average perpetual or moving average method? Same with FIFO perpetual and LIFO perpetual, we are going to consider each of these transactions. So let's start with the beginning inventory at again 1,000 units at 4.5, and then next we have purchases on 331 at 10,000 at 4.7, followed by a purchase return of 2,300 at 4.7 per unit also. Again, this 4.7 is taken from the latest purchase, which is this one. So some of you might ask, where is the averaging, sir? Well, the averaging happens just before a sale happens. So right now, since the next transaction is still purchase related on 7/1, that's purchase related, so there will be no averaging yet. So on 7/1, the purchase of 6,500 units at 4.6 will be added to the balance. However, after this, since the next transaction is already sales, then we need to get the average cost. But how do we do that? Let's add them all up. Of course, deduct the purchase returns, and we're gonna get 70,590. Let's do the same in the units column, and we will get 15,200 units. So the average cost can be computed by this 70,590 divided by 15,200 units, which is 4.644 per unit. We are going to use this 4.644 as the cost of the sales of 10,000 units. So we have 10,000 times 4.644, and we will have a total of 46,440, and we need to deduct that on this balance. So this transaction was followed by a sales returns of 1,500 units. And the cost per unit to be adopted by this comes from the most recent sales, which is the 4.644. So we need to put that right here. So we have a total of 6,966. And lastly, we just have to add the last purchase transaction, which is 3,000 at 4.8, and we will have 14,400. So get the total of 7590 minus 46,440 plus 6,966 plus 14,400, and you are gonna get 45,516 under the moving average. So that's the cost of the 9,700 units. So those are all the methods used in getting the cost of merchandise inventory end. So again, as a recap, the methods are specific identification. We have FIFO periodic, FIFO perpetual, LIFO periodic, LIFO perpetual, weighted average, and moving average methods. So that's it for this video. See you on the next episode.